Have you heard? Banks are gearing up for something big. Are you? In today's video, we're going to discuss exactly what's going on and how you can avert this crisis. I think it's important. A lot of people have to understand the truth so that we can thrive, so that we can prosper. We don't want to be victims of this, and that's what we're going to discuss today. I want to look at what's going on, identify the problem, and then we can provide the solutions to that. Number one, we're going to look at what's happening with the banks and with debt. And when we start to piece these things together, it's strange. Let me show you something. Here we have it. Credit card losses are rising at the fastest pace since the great financial crisis. And so, yes, that is a problem, but we're still off from where we were back then. I'm not suggesting it is worse in that sense, but know that there's more debt than ever before, and interest rates are absolutely higher. Goldman Sachs predicts credit card losses will continue to climb through the end of 2024, early 2025. Why is that? Because the expectation is that the Federal Reserve will leave interest rates high for that long. We don't know. We don't know what's going to happen. But at this time, based on the different, they call it the Fed SEP. And all that means is where the Fed predicts inflation will be and interest rates will be at that time. What is unusual is that the losses are accelerating outside of an economic downturn, according to Goldman Sachs. Credit card losses currently stand at 3.63%, which is up 1.5% from the bottom. We have seen this from others as well, and I think it's important just to address a few things. Credit card losses bottomed in September 2021, but why? It's because everything was put on hold. Everything. You had the debt moratoriums of all kinds. You don't have to pay your rent, you don't have to pay your mortgage, you don't have to pay your student loans, you don't have to pay anything. And so people started to pay off their credit cards because at 22%, yeah, I'm going to pay that down if I have the chance. But now things are changing. The student loans coming through, you got to pay that now. There's no more moratoriums, all of the stimulus benefits coming through. So we know it's a very different environment than where we were a couple years ago. So imagine that. Imagine the circumstances of where we were at a couple years ago, how different it is today. And so I can cover that right here. You got to understand that defaults have risen. We've got these bankruptcies that are picking up, both individual and on the corporate side. And then with rates staying high, the problem is intensified. So the longer that stretches on for, the bigger the problem is. Even if rates don't go higher, if they go longer, we go longer into 2024, into beyond that, that's going to be a big issue. So it really all depends on what happens with inflation, what companies do. If prices stay too high, of course, then that's going to hit the consumer. I've heard from you many cases where you have said you don't see as many people going to that particular restaurant anymore. I've seen it. I've seen your comments. At the same time, I've read article after article talking about how, they're measuring how much tips that was sent to me by a subscriber today or yesterday. They're not seeing as many. They've calculated it out and tips percentages have dropped. You just look at all that anecdotal type of evidence that has been going on over the last little while, and things have certainly changed, meaning the consumer buying patterns are different. Okay, so keep that in mind. Okay, then we have this. Looking at the losses that are going on, why is this important? It's because you've got $1 trillion worth of this stuff that's out there, and that that they're not going to be able to just, pay off. It's not going to get paid off. We know that. That's a fact. In our view, this cycle resembles the characteristics of what was experienced in the late 1990s and somewhat similar to the 2015-2019 cycle, where losses increased following a period of strong loan growth and has seen similar pace of normalization thus far in cycle. I think that actually what will happen here is that there will be a lot more losses, and what springs out of this will be more inflation. How do they do that? Well, the government will say, we need to help these people out. We need to deal with that. As the losses start to pile up and the banks start to deal with the crisis, which they're already going through, then that essentially, how this works. The banks, the central bank, the Federal Reserve, they happen to be connected, and they are going to have a discussion and how they have to be, they're too big to fail. We need a little bailout. That's the way this goes. It won't happen overnight, and don't expect it to be smooth, let me tell you. Banks are paying up to protect their cash holdings from sinking further and to safeguard against future runs on deposits, according to Bank of America. Big and small institutions started doing this even before the turmoil in the US banking system in March. Yeah, they know that they're going to take on some losses and they are paying to get more deposits. Isn't it strange that they are paying for more deposits in a time in which they are required to keep zero reserves? There is no requirement. They have zero reserves right now if they want to, and yet they're putting more. They want more deposits. They want more, even though they got to go give it out at 4%, 5%, 6%. A lot of these companies are starting to offer certificates of deposit in the US. I've seen examples, I believe in the comment section, somebody was saying 6%. I've seen the same thing in Canada. Looking at this, you are having to give out high percentages. Well, what are you investing in these banks that's making more than that? Do you understand? If you are a bank and you got to give somebody 6%, what are you investing in to keep it at that level? You're taking a loss right now. These banks are taking a big loss. There's nothing that they can do to be able to go higher than that percentage. They have to, in a sense, because they want to keep people as customers, right? They want to loan to them. They want to do stuff. And the issue is that it's going on for so long. This isn't a little blip where, yeah, okay, we'll do this for a few months. It'll all be over. We can go back to normal of giving people nothing. Imagine they got to give 5%, 6%. They have to make 5%, 6% beyond that. So they're basically filling in their profit margin and they're not getting that. So the banks are in big trouble, big trouble. They got their own debt problems, as we'll discuss in just a second. But now they have this fundamental issue, which is going to hurt them bad. And so I want to discuss more on that and why I believe it will lead to job losses. Some big concerns are unfolding right now. Debt market tightens, see fiscal risks and rising defaults. Some headwinds loom as companies refinance at higher rates. Clearly, as they say right here, there's a global risk from deficit spending. My goodness, a little late to the party on that one, but here we are. And that's exactly what they've done over the last while. Of course, all these governments gone into massive, massive debt. Credit markets may be stable as the global economy proves resilient, but some of the titans of the debt world told Bloomberg this week that they see looming headwinds as the impact of higher interest rates slowly filters through the consumers and companies. And that is an absolute matter of fact. High yield companies face a looming maturity wall, and that's coming up over the next few years. So essentially, they need to make a lot of money in a relatively short period of time, and yet the prospects for that are dismal. Do you see that these banks are running headfirst into a brick wall? And you might say, who cares about the banks? I'm not invested in banks, or I don't care. Let them fail. These are the companies that could take down everything. If that domino falls, the rest go with it. This is a financial crisis, could be magnified from what we saw back in 2008. Because if you remember, the problem was subprime at the core. And then we realized, there's a lot of counterparty risk. You got the insurance companies, you got all these other things infected by it. But imagine when we go into this on a more fundamental level, just interest rates being too high for too long, and we can't handle that. This is massive, and I can't stress that enough. I'm just trying to tell you exactly how this is. Fed's Bowman signals that she favors more than one further rate hike. And now we're talking about more than one? Of course. Why? Because the inflation rates are too high for too long. They started to come up in certain indicators. And if you look at the core inflation rates that they love to use, we've basically been at this level for well over a year, and it's not necessarily coming down anytime soon, according to their stats, because a lot of these things are sticky. Okay, and then you have this case here, the National Bank of Canada. better positioned than many of the larger rivals to navigate a downturn that's poised to hit banks' balance sheet and customers. Why? Well, a lot of them were previously purchasing their homes at a low interest rate, and now when it comes due, they have to get it at a higher interest rate. As they say here, this could be in Ontario a $1,200 difference a month. Do you know? Because of variable interest rates. Do you know how many people would be able to withstand an additional $1,200 on top of all of their other expenses that were going up like crazy? This is wild. So the banks are feeling it. The consumers are feeling it. I know you've been feeling it. I've been reading your comments. I've been replying to you. I've been communicating on Discord. I've been doing it in the mentorship group. I am talking with people, and we're going to discuss what you need to do. Because here is the problem. We are aware of it. We know of it. And now we've got to address that. We don't just talk about this stuff. Leave that to the other guys. The other YouTubers will do that. But on this channel, forevermore, we are going to be focusing on the actions that you need to take so that you can thrive and prosper. Oil nearing $100 is a red flag for central banks' inflation fight. Crude is approaching $100 in its new headache for policymakers. Volatility coincides with higher for longer rates outlook. So this is all connected. Of course, you can look at what's going on with Saudi Arabia. Of course, restricting this. Talked about that in previous videos. If Saudi Arabia is going to restrict output on their oil, certainly that will reflect in the price. We know this. But it's just one component of many where the prices are rising on just about everything, it seems. So oil's a problem, gas, transport in general, all of these things. So know that that's just hitting people where it hurts right now. And so that's all part of this. What's next, you might ask? AI fantasy fades as Wall Street reels from real world rate jump. Of course, as soon as, as soon as like you saw Nvidia stock, like it was going up, like $100 billion a day. It was just flowing towards them. And the valuations, I was looking at all of these individual analysts. They were giving these valuations that were absurd. Oh, the stock is going to be 400 tomorrow. The stock is going to be 1,000 tomorrow. It's going to be 2,000. It's going to be 10,000. They were just giving everything. And the stock kept climbing. But what was it all about? It was about the fact that we are expecting a rate cut soon from the Federal Reserve, and that there's a never-ending supply of money that will go into AI stocks. And Nvidia happened to be the one that positioned themselves as the new AI champion. That a lot of the liquidity was starting to leave like Tesla and things, and it was moving into Nvidia and some other companies. The point is, we get this when there's turmoil, not when there's, Goldilocks, when there's turmoil. And that's what's going on right now. And we could see that there is not as much liquidity as there was before. If you can see that over here, and that's the last few days of the S&P 500, all red. Okay, and they're worried for good reason. So what is it in the end that you may experience? Well, I can tell you that as we have these layoffs, they will be replaced every single time with robots if they can. This is just a little funny piece. I thought it was funny. This actually went viral. You can see it has 11 million views. With the RoboCop, it cannot make the heart with the mayor because it has no arms. And you can see he's doing the little heart thing. And, it's saying, hey, they're going to put these out. These are the new security for the NYPD. It records video only, doesn't record audio. And it's going to go around and it's going to make the subway safer. Anyway, the point is, all I'm showing this is because they are putting robots wherever they can. That's all. They're going to do it in the fast food places where California is saying, hey, we're going to pay our employees $20 an hour. If you're in the fast food industry, you're going to get $20 an hour. And that's great in a sense for those people making $20 an hour. But the obvious truth is these companies won't pay that. And they're going to implement Flippy the robot and all these different robots. They're going to a new model where you walk in, you don't talk to anybody, you type it on the screen, which, by the way, I've seen the studies on those touch screens, a lot of feces on there. Or you're going to go to your phone, you're going to tap that in on your phone, you're going to be able to come there, you're going to pick it up, and there is not any human interaction. There might be a human in the back somewhere working, but you won't see him. And that's the way it goes, okay? And so if you want to know what you can do, well, let me tell you, you came to the right place, okay? These are just a few things, and on the end of every episode, I do cover these things. So just understand, this is just a small piece of the total. It is essential to increase your income at all costs. At all costs. Anything that you can do to increase your income, sell the stuff around your house, sell services that you have, work a second job, get a side hustle. In my opinion, a side hustle is much better, one that you can do online, and there's many reasons for that. This is something we talk about all the time in the mentorship group every single week. Invest only in companies with strong balance sheets. So if you are an investor, please be honest about yourself and what you're putting your money into. Look at the ones that can weather the storm. And speaking of weather the storm, real assets. Real assets are what can weather the storm during this period of time. And that's what we need to have more than anything else. If you want to be able to go through your own finances, understand where you are at, you can do that with Compass. Compass right here is where your financial journey starts, and it's totally free. All right. So you can get that at my website, themoneygps.com. Themoneygps.com. I want you to go over there, get that done for yourself. It's like 20 minutes through the whole thing, super short videos. And I want you to be there. And then when you're done, give me that feedback. Okay. It's very important that I create these things for you, because I realize that we all need that financial education. Get that done, themoneygps.com. And the comment of the day, I thought this was fantastic, because it shows that people are preparing. And what I'm going to do is highlight in each circumstance comments, number one, but also any case study that I can. And this happens to be sort of a 2-in-1. Here we go. Thank you very much, the Dirty German, for your comment. We repainted the living room and needed a new doorbell cover because the old one was from the 1970s. The doorbell cover was $30 on Amazon, but Thingiverse, which is what I talked about in the previous video to this one, which is basically, you can 3D print stuff, and they give you like the schematics, the diagrams. All you got to do is take that thing, that file, and input it into your 3D printer, hit a button, and it gives you what you need. Free. Okay. Anyway, had a better one, which could be 3D printed for about $1.50. This is deflation, $30 to $1.50. And that is so key. And it makes me so happy to hear that that is part of preparation. And these 3D printers are just one small aspect of it, but it is a part. And so I want to thank you for that comment. And I'm going to continue to highlight people out there through case studies, through comments, that are doing these kind of things to celebrate it, and also to show you that we will thrive and that we will prosper in these most difficult times. If you're with me, hit that thumbs up, subscribe to the channel. These are the things that we talk about each and every day. So I'll see you on the next one. Take care.